Steinle, Director of Business Development at Lear Investment Management. Welcome to the February 2023 Market Perspectives webinar. Many of you are already aware of how important communication is to us, not only on these calls, but also in our portfolio management process. Communication that goes beyond just reciting market metrics. It's imperative that investors understand what they own and, more importantly, why each security is in the portfolio. We just published our 2022 year-end letter. It's quite good. If I say so myself, I would encourage everybody to read it. In it, we highlight our belief that we are transitioning from one secular investment landscape to another, and also highlights the themes we believe will drive growth opportunities in the future. So with that, I'd like to introduce your host, co-portfolio manager and director of research at Lear, Jim Warner. Jim will walk us through how we view the market, the themes that drive our investment decisions, and how they are currently being played out in the portfolio. Jim, welcome, and glad to have you with us.
Thanks, Tom, and thanks everyone who is on the call. I'll go ahead and share my screen like I normally do. All right, well, good morning or good afternoon, wherever you are. Thank you all for being here. This month's monthly strategy is going to look and feel a little different than in the past. And I'd actually appreciate your feedback. One of the things that we want to try to get accomplished here is to really address actual specific positions and themes that we're using in the portfolio. So I hopefully, the mess, and try to shorten it up a little bit too, in order to, really give you, arm you, with more knowledge about what your clients own and the rationale behind it. And if you're a perspective, hopefully this helps you understand a little bit more about how we think. So secondly, my hope is that this format will encourage more questions and discussion. And to further encourage this, as I mentioned, I'm shortening the length of this presentation. I think as Tom mentioned, and he's mentioned before, that there'll be a Q&A afterwards. There's an opportunity in the box, the Zoom box, to post questions, and we'll address those. And if you can't figure out how to do that and want to just email me directly, feel free to do that. My email is jim@learim, as in Mary, .com, jim@learim.com. So, all right, so let's jump in. This month's market strategy update is going to address a question that we are getting from investors and advisors. After experiencing a surge in the markets to begin the year, the question is this the beginning of a new trend? Or conversely, just another bear market rally? All right, so the equity market got off to a great start. As you recall, December was a terrible month for stocks. So some mean reversion was expected. In fact, this happens often in January. The worst performers in December are often the best performers in January, and this January exemplified that. The battered NASDAQ jumped 10.7% during the month, dramatically outperforming the Dow, which you'll recall vastly outperformed the NASDAQ last year. Again, you see the mean reversion. Importantly, the VIX dropped and remained below 20, which means volatility declined to a level that is more receptive to risk-taking, and so we saw risk-taking. As we've discussed, the market narrative has shifted over the last, let me go back. The market narrative has shifted over the last few months from inflation to concerns over economic growth as the market calibrates interest rates. The labor market is a critical driver, and during January, we saw continuing strength. Continuing claims, although a bit higher, are still near record lows, while the unemployment rate has fallen to 3.4%, the lowest level since 1969. By nearly every metric, the labor market is still very strong, and this is confounding the Fed's view that the labor market needs to soften as a necessary requirement to returning to their inflation target of 2%. We would expect the Fed to remain hawkish until this data weakens or until their hypothesis is disproven. On Friday, the BLS released the monthly jobs report showing the economy added a net 517,000 jobs in January on a seasonally adjusted basis. That's important, seasonally adjusted basis. This report was more than double expectations and caused interest rates to immediately jump and stock prices to pull back. From our analysis, this report should largely be ignored, as statistical adjustments made by the BLS to the normally large seasonal adjustment that always applies in January, it created an extra large distortion. If you ignore that number and simply look at the non-seasonally adjusted number, a different picture emerges. In January, the economy actually lost 2.5 million jobs. And from the graph below, you can see that the economy typically loses jobs in January as seasonal holiday workers roll off and as companies announce layoffs. You can see it at negative 2.8 million last year and negative 2.6 million last year on a non-seasonally adjusted basis. So this was kind of a weird seasonal print. Over last year, our view on the economy has diverged from consensus insofar as we anticipated the goods producing part of the economy would enter a recession, and we think that has occurred. We've been less convinced, though, that the services part of the economy would follow suit. In January, both the S&P Global and the Institute of Supply Management's services surveys showed a rebound. In our view, so long as the labor market doesn't fall apart, services should continue to see growth. The Fed, as you know, raised the overnight interest rate to 4.75% last week, as expected. The Fed funds futures curve now implies that the Fed will make one more 25 basis point hike and then pause until year end. The market, as you can see, expects that the Fed may have to cut rates due to economic softness as we enter 2024. The closer the market gets to the end of Fed tightening, this dialing in is permitting interest rates to stabilize. The bond volatility index, which we talked about last month, I believe, has fallen significantly as a result, and that has created a great environment for bonds and perhaps a foundation for increasing bets on growth stocks. You can see that the U.S. 10-year Treasury, the chart on the right, the bond yield, its bond yield also reflects this stabilization, which is helpful. So with that backdrop, it is fair to ask, is the stock market beginning a new market cycle, or are we still stuck in a bear market? So let's first take the optimistic view. From a purely technical perspective, stocks are breaking out. The top chart shows the Russell 3000, a broad measure of stocks, broke through that long-term downward resistance. And that bottom chart shows that twice in the last month, more than 50% of the stocks in the index reached new 4-week highs. Going back into history, this almost always is a sign that a new upward trend is developing because it indicates broad buying. And we're seeing the same breakout occurring even in the more growthy technology-oriented NASDAQ composite. However, the percentage of stocks hitting new 4-week highs has stopped short of 50%, indicating a little hesitancy, but certainly it's a move in the right direction. Now, there's a little history to support a bullish view today. Since 1950, there have been 14 years in which the S&P 500 rose 5% or more in the month of January. And in 13 of these years, the index finished up for the year. The average price return for the S&P 500 across these 14 years was 22.9%. Here's where I warn you that there is no guarantee that this year will be one of the winners, but data may suggest that bullishness in January can be carried throughout the year. And if this upward trend is truly real, there are a lot of investors that will need to chase this rally as sentiment remains quite bearish. The fear of missing out may be particularly acute this year due to last year's losses. So the technicals suggest we may be in a new uptrend, but the fundamentals and valuations cast shade on that optimism. It remains the case that earnings estimates still look too high, and valuations are not cheap enough to protect against a full-fledged recession. With half of the S&P 500 having reported earnings estimates have only been revised down 5%. Further, the S&P 500 is trading at 18 times that estimate, which is above its 20-year average of 16.8 times, and it's certainly not priced for a full-fledged recession. In addition, the relative value of bonds to stocks is the highest we've seen in the last decade. The Fed model presented here compares the earnings yield of the S&P, which is just the PE inverted, and to the yield on the 10-year Treasury bond. And it suggests that one must only give up 1.8% in yield to obtain a risk-free return. So the question becomes, why own stocks? All right, so how does this translate to our portfolio strategy? This pie chart below provides the approximate asset allocations for our conservative, moderate, and aggressive strategies for all of the models that we manage. As a tactical manager, one way we manage risk is to change these allocations, and this happens dynamically. Today, we are at the conservative end of each of these risk flavors, which reflects a bias towards fixed income and our selectivity in owning stocks. With nearly half of our moderate strategy in fixed income, you might ask, what's in it? So this isn't your grandmother's collection of traditional fixed income with T-bills and a total return bond fund, although we have those too. Rather, 10% of the portfolio is allocated to mortgage-backed security REITs. These are essentially mortgage-backed security portfolios that utilize leverage to amplify returns. The investment conditions, as we've mentioned on previous calls, are exceptional today. Surging mortgage rates and the end of Fed purchases created a panic in 2022, causing spreads to blow out and base rates to surge. But with the base interest rates stabilizing, the proverbial dust has settled, leaving a once-in-a-decade opportunity. Various portfolios have exposure to this trend in different ways, but the three most used securities are NLY, which is Annaly Capital Management, AGNC, another mortgage REIT, and REM, which is an ETF full of mortgage-backed REITs, mortgage-backed security REITs. These are investment vehicles that use leverage to enhance this already attractive opportunity. The year-to-date returns have been exceptional, and the dividend yields remain very attractive, double-digit. These positions are a great example of how a little creativity can create equity-like returns. Technology was a wealth killer in 2022, and even our underweight portfolio weighting turned out to be too much exposure. The bubble has burst, interest rates have stabilized, and we have started to rebuild exposure by adding QTech. QTech is an ETF that represents the NASDAQ 100 equal weighted, and this gives the portfolio some added exposure to growth. Thus far, this trade has returned approximately 19% year to date. Catching a falling knife is a euphemism investors use to suggest that making money on a stock or industry in free fall is very difficult to do without getting cut. And so it is with technology stocks. However, there are still very attractive themes to play, including artificial intelligence and the digitalization of the enterprise. And among the rubble are likely the next Google and Microsoft. One of the best examples of the dangers of trying to catch a falling knife is Peloton. If you bought this stock precisely on January 3rd, you'd be up about 92% year to date. But if you owned it 2 years ago, you're still down 90%. And down if you bought it anywhere in any time in between. Right now, the relative strength index tells us that the stock is overbought. Someday there will be an opportunity to buy this stock and others like it. But again, you don't want to try to bottom ticket. All right. So one other specific area worth mentioning, because we talked a lot about it last year, is the portfolio's exposure to natural gas? And the answer is very little direct exposure to natural gas prices, which, as you can see in the chart, those prices have cratered to levels now below when Russia invaded Ukraine. A combination of a warm winter in the Northern Hemisphere and high inventory levels forced us to exit any direct exposure. What is left in the portfolio is AMLP, which is an ETF comprised mainly of midstream pipeline companies that transport natural gas and oil, and Cheniere Energy, which produces liquefied natural gas and oil, liquefied natural gas and export terminals that they then send out to Europe and Asia. Both of these companies have very little direct exposure to natural gas prices under their contracts, and they hedge out whatever is not covered by those contracts. However, in light of how low the commodity has fallen and with the reopening of China, we are once again looking to increase exposure to this area. All right. So when we talk about the global vigilance portfolio specifically here, and this is the moderate risk profile, it's often easier to see it in pictures. And I'm not going to spend a lot of time on this page. We can come back to it in the Q&A. But you can see the various themes that are in the portfolio that, especially on the stock side, that offer value and durable earnings regardless of the economic environment. But you can also see, just from a size perspective, just how much fixed income is in the portfolio. So to sum it up, I want to reiterate our boring message for 2023, which was be patient. I know that after a year like 2022, when everything was down, it's really easy to chase returns like the ones we're seeing in tech right now. Until the economy fully digests these huge Fed rate hikes, we think stocks are likely to be choppy. So stock selection is critical. We want some stock exposure in case we're wrong, but it's not time to push all the chips to the middle of the table. And while we patiently wait to transition into a new market cycle, you can find protection and yield in fixed income that has not been available for years. So be patient. I'll stop there, Tom, and let's open this up. And I hope we have a robust Q&A session.
Terrific. Please enter your questions in the Q&A box at the bottom of the screen if you have them. Otherwise, you can email me or Jim directly. One question that I get, Jim, it's not in the Q&A box, but I've had several advisors talk to me about adding a little bit more risk in the portfolio. I know you just said, we don't know whether we're out of the woods and we need to be patient, but what do you need to see? What do we need to see in order to add more risk to the portfolio?
Yeah, so a couple of things. One is we do agree, first of all, as I mentioned, the asset allocation looks a bit more conservative than it actually is because of the mortgage REITs that we have in the fixed income side of the portfolio. And those things are producing, pretty enormous returns. But you're right. That's the thing that keeps us up at night right now, which is how quickly and how aggressively do we add exposure back to stocks, and I think in particular technology. If you stop and think about where we are in the market narrative today, there's still some doubt over when or if an economic slowdown is going to occur and how deep it will be. People throw around terms like soft landing. I don't like that term, but basically, what we're watching very closely is, does the services part of the economy roll over? And so clearly that is going to throw some question marks into names that are like in the consumer discretionary space or financials with exposure to the consumer and other cyclicals like that, which then kind of forces us to turn our attention, whether it's just to idiosyncratic names that have very unique aspects to them, like we have in the portfolio today, but also to start to add back technology exposure. It is so beaten up that some of these names are incredibly cheap, and that's something that we are actively working on as we speak.
Great. Couple of other questions here. What would you say to a client who is influenced by the media to believe that a disaster is around the corner? And then he adds, I disagree with that statement.
Well, they should listen to this call and not listen to the media, of course. Yeah, no, I mean, the media gets it wrong a lot. If you think about what you heard over the weekend when they reported the payroll number, there was, wow, we added over 500,000 jobs. Well, it turns out that's not the case. And it'll take time for people to figure out what the right answer is. We try to give you those answers as quickly as we can figure them out. Yeah, I mean, it's very troubling, and it's difficult to respond to those questions because there seems to be, almost an authority that if somebody said it on CNBC, it must be true. And, this is something we navigate with our clients as well. All I can tell you is that usually goes in one ear and out the other in our shops. We always go back to the data and we form our own opinions. And, that's why we have these calls, is to share those with you.
Any more information on projected S&P earnings that support or not a 4,100 index?
Yeah, I mean, it's really hard to get to the math to support that. I mean, if you, and it first starts with what are earnings estimates supposed to be? And, as I mentioned, we're about halfway through this earnings season. And this is usually a critical earnings season because this is where a lot of companies will first issue their 2023 guidance. And by and large, people are taking down their numbers, but not by very much. We still have another half of the S&P to report. And so, I think it's going to be very interesting to see where this all shakes out. I personally would like to see the Band-Aid ripped off and earnings estimates really lowered across the board. I actually think that stocks might react favorably to that. Normally, normally investors don't want to see that at all. They want to see estimates go up. But I think that would take a lot of the fear out of the market that, we're kind of at levels that don't make sense. To be at 18 times a number that you don't think is that needs to go lower is usually a recipe for the market to head lower. And that really is at the core of why we're hesitant to just chase risk at this point.
Gotcha. So I think this is a related question, but I think you just answered it. Is it possible to have a new normal of 18 times PE rather than having it come down?
Sure, anything's possible. I mean, I think, one thing that could drive the acceptance of a higher multiple. First of all, what generally happens, just to back up, is when you're going into a recession, the market figures it out first and multiples collapse. And we've had the multiple in the S&P go down as low as 16 times twice and then bounce. And I've shown in previous presentations that normally what will happen is the market will kind of bottom out around 14 times. And what that implies is that, EPS estimates need to come down usually 15 to 20%. So just to kind of put that historical context in place, we've never gone, we would usually see that compression in the PE, and then the PE expands as the estimates come down. And they usually expand, if you take a super cyclical company like a steel company or a paper company, manufacturer, oftentimes you'll see these enormous multiples when, at the beginning of a good cycle. And that's just because the earnings are so low. We're not anywhere close to that. So the only other way that I could see multiples expand is if inflation really dropped off a cliff. If we saw inflation really roll over hard, like much faster than what the market's expecting, that would add some fuel to the fire. So, but because we don't see that necessarily happening, we are, you're sort of stuck making sure that what you own has really solid earnings. So you're okay with that thesis that, the numbers don't need to come down, and you're okay with the valuation. And that's really how we position the equity side of the portfolio, is to make sure that we're there so that if the market just keeps going, we're going to participate for sure. But but what we own, we know that those earnings are good to go, and that even if we go through recession, those will be fine. And how do we do that? Well, that's the magic of the stock selection process and our investment process. And a lot of it rests on a lot of due diligence and also really understanding the secular tailwinds that are helping a particular company. And so, yeah, I'm happy to go into further into that, but.
I think that's good. That actually ties into another question, which is what are the sort of the overarching themes that are driving the security selection process going into this year?
So what I'll do is I'll share my screen again and go back into the presentation and show you that visual map. I think that might be helpful.
Yeah, I think so too.
All right, let me do that. Can you see the screen okay?
Yep, you see it.
All right, perfect. So if we just focus on, like, let's say the middle yellow columns, one of the things that we think that there is is the natural resource scarcity. And this also works with the theme of, the transition to clean energy. And so one of the areas that we have really dug into is the Infrastructure Act and the Inflation Reduction Act, which you'll recall has enormous rebates and incentives, financial incentives to, buy electric vehicles, install solar panels, wind farms, et cetera, et cetera. So we own sort of the one of the best clean energy renewable utilities in the country that are also on the forefront of hydrogen development. So, and benefit significantly from some of the subsidies that I just mentioned. We also own a company that is really the #1 producer of renewable diesel. And that biodiesel is a huge trend because it burns very, very clean, and it's made from animal fats and also used cooking oil. A little disgusting, I know, but it's a tremendous business, and it's really due to grow significantly. I touched on Cheniere Energy. There's a business where the world needs more LNG. And I don't probably need to explain that to anybody on the call or listening to this. Europe needs to convert to natural gas fired electricity like a year ago. And so and China is a massive consumer of LNG. And so we own the #1 player there. Turning to some other more unique names, for example, we own a nurse staffing company. There is a absolute lack of supply of nurses out there today. And one of the reasons, and COVID only exacerbated what was a negative trend in the supply of nurses. It's just the average age of a nurse is 53 years old. They're all retiring. That the pace of retiring has accelerated due to what they had to go through during COVID. And you're just not getting enough nurses coming out of the nursing schools to fill that gap. So there's a really interesting supply and demand issue there. I think the other thing that I'd point out is we also own a pawn shop. And I know there's sometimes people have a negative connotation to pawn shops, but actually for the people that are underbanked, this is maybe the best and most humane way for them to access cash. For the few $100 medical bill that pops up and you need a quick cash, you can go get a loan off of your tablet or your guitar or whatever, or some jewelry. And the worst thing that can happen is that you lose that item of that you've traded for. So that is obviously something that is this particular business is just extremely well run and operates in the US and Mexico. And this is, they're basically seeing a surge in demand as all of those fiscal stimulus dollars get spent. So I'll stop there, but was that helpful?
It is. Actually, there's another question that ties into this chart of the themes that we're currently working with, and that is, can you talk a bit about how you feel about foreign equities, and do you anticipate participating more in global names?
For sure. Where we have exposure today, it's a little bit less than 10% of the portfolio is in foreign equities, but we're participating in a Japanese technology name as well as an Indian bank. And we are, India to us is just an incredible economy that is, you've got, an enormous population, a growing middle class, and it's just an incredible opportunity for a bank. Banks are oftentimes just levered bets on the economy, and so that's been in the portfolio for a while, and we will probably keep it in there for quite some time. Japan is actually an interesting one, and we've been doing a lot of work in Korea, Taiwan, and the Philippines, principally because as China reopens, those economies are going to really dramatically benefit from that reopening. And we've done some other things. We exited Europe when the invasion occurred, for I think obvious reasons, but Europe's had a tremendous comeback. What's wild about what's going on in Europe is that the sort of horrible energy crisis and then recession just really hasn't happened. And thanks to a warm winter, they got bailed out. We're not huge, we're definitely doing some digging. There's some names that we've gone to in the past that I think are interesting, but we're also don't want to be chasing some of these big REITs that we've seen in the market in the last month. So, we're definitely paying attention to what's going on in other parts of the world.
Great. I'll give us about 15 or so seconds to see if anybody else has another question, Jim. But as you pointed out at the beginning of this webinar, this format's a little bit new for us. It was based on some feedback that advisors and their clients want to know how the portfolio reflects the what's going on in the market and the themes that we're following. And we're really interested in your feedback. So please don't be shy about emailing me or Jim or whoever your point of contact at Lear is, and letting us know whether this was helpful. We want to make sure that we're providing you what you need, and that we're continuing to improve. So your feedback would be very welcome. I don't see any more questions here, Jim, and it's about 12:35 Eastern time. So I don't want to keep anybody on the call if there's no more questions. So anyway, everybody, thanks. Have a great rest of the week. We'll talk with you again in March, if not before. And thanks for tuning in. Jim, thank you.
Thank you. Thanks, everyone.